What if you could buy $18,000 of stock for just $200? Would you do it? Well, you can't exactly, but you can almost do it. With the options market, you can create synthetic positions on stocks or ETFs for a fraction of the cost of what it would be to buy the underlying outright. Options create passive income, can be used as a hedge against losses, and, of course, it can mimic a stock position for a fraction of the price. And these are called synthetic positions, and they can be very powerful tools in the right hands. They allow traders to replicate the risk and reward profile of an underlying position with a fraction of the capital you normally need to get into the trade. In this video, I'm going to be covering what synthetic positions are, why they're helpful, and of course, I'm going to break down the strategy. But before I dive in, let's make sure we're all on the same page. Options are financial derivatives. They're contracts that allow you to buy or sell a specified asset at a specific strike price at or before a specified expiration date. When you're buying an option, you pay a premium. If you're selling, you get the premium, which is usually expressed on a per share basis. One option contract represents 100 shares of the underlying asset. Now, when it comes to options, we can also replicate the desired result of an underlying, like a stock or an ETF. Synthetic positions typically mimic holding an underlying asset, but they can also replicate an option strategy. They allow traders to mimic the risk and reward profile of the target position with less capital or different risk characteristics. Now, let's start with the most common synthetic setup, the synthetic long stock. A synthetic long stock is an option strategy that mimics owning an underlying asset. The strategy involves buying a long call and selling a short put with the same strike price and the same expiration date. What this basically does is it anchors you to the strike price in the same way your purchasing price does when you buy a stock. The only difference is that you pay for the long call, and the short put essentially subsidizes the purchase of that long call. It means you get control of 100 shares while paying a fraction of the cost of the stocks themselves. Now, if the stock increases in value and exceeds your long call strike price, the option is now in the money, and your position begins to generate a profit. Like with holding a stock, your maximum profit is unlimited. Now, if it doesn't work out and the stock moves down instead, well, there's a twist. If the stock price moves below your short put strike price, that option will now be in the money. And on or around expiration, you'll now be buying 100 shares of that stock at your strike price, which you can either keep or sell at the current market price and take a loss. Let's explore these concepts with a live example with NVDA as the underlying. Let's say you're bullish on NVIDIA and you think there's a big chance that it's going to reach new highs in the near future. So let's look at creating a synthetic long position on NVIDIA. First thing you do is go to barchart.com if you are already there, search for NVIDIA up here, and then go to the stock's profile page. From there, look to the left side of the screen and click on Long Call/Put under Option Strategies. You'll be brought to the option screener for long calls, where you'll be able to find trades for the nearest expiration date, along with other information like probabilities, percentage returns, and the Greeks. By the way, I made a full deep dive covering the options Greeks, so you may want to check it out up here. Going back, the first thing you need to do is consider your expiration date. Let's say you want to enter a synthetic long on NVIDIA that expires in about 3 months. For that, we can pick December 19th, 2025, or about 81 days from the time of recording. Then, you need to decide on your strike price. Now, synthetic long stocks are usually set at the money to closely mirror the behavior of the underlying stock today. This will give you nearly identical gains and losses if you had owned the shares outright. Since NVIDIA is trading around $181 today, let's look at the $181 strike long call by typing 181 here and then click Apply. And there we go. This $181 strike call costs $14.95 a share, or $1,495 per contract. You can also see other trade metrics and figures right here. Now, that's it for the long call, but what about the short put? Well, you can simply click on Naked Put and you'll be brought to the Naked Put screener page for trades that also expire on December 19th. Now, all you need to do is type in 181 on the strike search box and you have your list. According to the screener, you can sell a $181 strike put on NVDA and receive $12.30 a share, or $1,230 per contract. Since you paid $1,495 for the call and collected $1,230 for the put, that brings your total net debit to just $265 per contract. And this is the magic. It means that instead of paying $18,100 for 100 shares of NVIDIA, you'll only pay $265 for the very same exposure to those same 100 shares. Now, before you run off to your brokerage and enter into one of these positions, remember that when you're selling puts, your brokerage will require you to maintain enough cash or margin to cover the potential purchase of the shares if you're assigned on the short put. Because remember, synthetic replicates both the upside and the downside of the underlying. Now, let's see how this plays out if NVIDIA rallies. Suppose the stock jumps to $200 before expiration. Well, now your $181 strike call has intrinsic value of $19 a share. Can you calculate that by taking the current trading price minus the strike price? That means your call option is now worth at least $1,900. You could exercise the option, buy 100 shares at $181 each, and then immediately sell them at $200, making you a nice $1,900 gross profit per contract. And since you initially paid a net debit of $265 to get into the contract, your net profit is $1,635. But exercising isn't usually the most efficient way to capture value, because options also carry extrinsic value, or the part of the premium that accounts for factors like time to expiration, implied volatility, and market demand. So instead, you might just sell the call back to the market. Let's say it's now priced at $20.50 a share. That's $2,050 per contract. Since you initially paid a net debit of $265 a contract to get into it, your net profit works out to $1,785. And don't forget, you also have a short put in play. Since the stock rallied, the short put will now be worth a lot less than you paid. So if you believe that NVIDIA will stay above the strike price at expiration, you can let the option expire worthless. Or you can issue a buy to close order to close that side of the trade. But what about the downside? Well, if NVIDIA drops to, let's say, $170 at expiration, now your $181 strike put will be assigned. It means you'll be obligated to buy 100 shares of NVIDIA at $181, even though the current price is $170. And since you paid a $265 net debit to set up the position, your total net loss is $1,365. Now, you will still have a call option that you can sell, but its premium will have probably eroded significantly. Selling it may help reduce your net loss, but it may not be worth it, especially if the trading fees exceed the premium. And there's your trade-off. If you had owned the shares alone, your loss would have only been $1,100. Let's consider the profit and loss scenarios depending on where NVIDIA might end up at the option's expiration date. For this synthetic long position, the break-even is the strike price plus the net debit or credit. In this case, it works out to $183.65. As you can see, the only difference between having the synthetic long stock and owning the stock outright is the $265 debit in this case. Aside from that, the synthetic position rises dollar for dollar with the stock after it breaks above the break-even price. By the way, and this is very important, regardless of what happens to your trade, you should always close your short positions before expiration. Even if the chance of a massive price swing against you is low, I always find it best to just avoid taking that risk, even if it means closing that short position, which will cut out a little of your profit. So that's how to form a synthetic long position. In a future video, I'm going to cover synthetic short positions as well as other more advanced strategies using options. So if you haven't already, be sure to like and subscribe to the channel so that you won't miss it. Okay, so at the end of the day, why would anyone trade synthetic positions when you could just buy the real thing? When entering into a synthetic long position, you get almost the same exposure without paying the full price of the 100 shares of the underlying. However, you do not get any dividends or voting rights in those shares. And of course, there's no such thing as a free lunch, and there's no such thing as a risk-free investment. So let's cover the disadvantages of synthetic positions. First, getting into a leveraged position means that your losses can also be amplified. For example, with a synthetic long stock, if you initiate the trade at a debit, well, your maximum loss will actually be greater than owning the stock outright. And this is because you're getting the full potential downside of the stock plus the initial debit that you paid to get into the trade. And it also means that your upside will be lower than owning a stock outright. And that's because of the initial debit. And the next potential risk is higher fees. With synthetics, you're getting into 2 trades instead of 1, which means that trading fees could be higher. If you misjudge those fees, it could potentially affect your bottom line. I mean, you might think that closing your positions would result in a small, tidy profit, only to find out that those fees eroded it. Then you'll also need to consider assignment risks. Every option strategy that has a short component puts you at risk of assignment, early or otherwise. Early assignments typically occur when the option holder has an incentive to exercise before the option's expiration date, like when an ex-dividend date is approaching or when short options are in the money with very little time left, in which case the buyer may decide to lock in the intrinsic value immediately rather than hold the option any longer. On top of that, short positions, especially short puts, typically come with margin requirements, meaning your broker will require you to maintain sufficient capital to cover your position in case you're assigned. That margin is usually locked up until the trade is closed. Then you don't actually get any benefits of the stock ownership itself. Lastly, synthetic positions can be complex, and traders with limited experience might struggle to comprehend those underlying concepts behind the strategies. And this may lead to misunderstandings or even underestimating the risks, payoff, and loss profiles. Overall, synthetic positions can be a powerful way to have complete exposure, upward and downward, of an underlying position at a fraction of owning it outright. That means they can be capital efficient ways to achieve your preferred exposure without paying the full price. Still, they come with their own sets of risks and the complexity behind the setups, which may lead to some traders believing that the straightforward route is better for them. Now, if you do use synthetics, always ensure that you understand both sides of the trade and its risk and reward profiles. But what about you? What do you think about synthetic positions? Do you have any questions about them? Let me know in the comments below. And while you're there, if you found this video helpful, do like and subscribe. It'll help others find the video, it supports the channel, and you won't miss out on any of our future deep dives. That's it for me today in this video. Thank you so much for watching, and I'll see you next time.